gold and look at the analysis. So for some reason, gold is moving higher after mitigating our 4-hour fair value gap. So we have our 4-hour fair value gap here. You can see the fair value gap very nicely. Price mitigated that fair value gap. So all we wanted to see was a mitigation, and after that mitigation, a 15 minutes break. And so far, you can see it's pretty much breaking the 15 minutes high. So once the 15 minutes high is broken, what I would recommend you do, because there's no guarantee that price will come down to this level. There's absolutely no guarantee. And I'm not training you to try to predict the exact point price will reverse and start going towards the direction. What I'm training you to do is mark your zones, mark your key levels, wait for reaction. The reason you do it this way is it removes, number one, emotions. We are emotional beings. It's hard to remove emotions and when we're doing things. But if you're systematical, it helps you to detach from those kind of emotions of you trying to be right. In this case, you're not trying to be right. You're literally following a strategy, and the strategy says this is a last down close candle from the 16th-hour time frame. Last down close candle before breaking that significant 30-minute structural high, which is this key level. This key level was our break of structure on 30 minutes. So all we want to see is a mitigation of the last down close candle, and we look for fair value gaps to align with that analysis. And the fair value gaps we're looking for is one is this one right here. You can see the fair value gap. Price is in there now. And the second fair value gap is in here as well. Fair value gap, fair value gap. We want to see a mitigation. After that mitigation, once price mitigates any one of these fair value gaps, we want to see a 15 minutes break of structure. And right here, you can see we have a 15 minutes high, 15 minutes low. Price rallies above the 15 minutes high. It hasn't broken it yet. Why do I say it hasn't broken it yet?
Because it's only the wick that close above, but not the body of the candle.
Exactly.
Okay.
You want to
Because
say something, God's time.
yeah, because why I don't consider this a break of structure until the 15 minutes current candle closes above the previous this current highs now. Then I can say that is a proper break of structure.
Exactly. So we want to see this 15 minutes candle close above this high. If it doesn't close above it, then that means this was a run on liquidity, and then price will aim for the low.
Yeah.
So we need to see a candle close above this high. And if that candle closes, which area are we going to use as our entry? Let's say this candle closes above this high. Where will we set our limit order?
Here, and the last one close candle.
Down.
Exactly. Perfect. You can use this last down close candle. You can use this fair value gap here.
Yeah.
It's entirely up to you which one you want to use. None of them is wrong. They are both right. You can even put your box from that fair value gap to the last down close candle.
Yeah, none of them is wrong, but one of them will let you enter with a stop loss much nicer than another one.
Yes, true. So using this last down close candle, your stop loss will be smaller, but the disadvantage is this person using the fair value gap, there's a higher chance the person will get activated. Price can actually come down and tap the wicks of this last down close candle and reverse and go up to the upside, and you won't get activated because of spread. But someone who used that fair value gap from here, price coming down here will give them ample amount of range to get in. So they both have their pros and cons. This one, using the fair value gap, it will literally, you drew something on the screen. So
sorry.
So this one, if you're using the fair value gap, there's a higher chance you get activated, but your stop loss will be slightly bigger. Using the last down close candle, price can still tap the down close candle, but just tap on the wicks and reverse, and you miss the trade. So these are factors you have to be aware of. And even if, let's say, you take this trade, let's say price breaks this high, because we have 7 minutes left before this candle will close. Let's say this high gets broken and price comes in here and breaks the low. Don't feel shattered. Still mark what you still want to see. Still wait again to see another break and use the retest. It means they induced liquidity here to wipe it and then break to continue higher.